Hi, everyone. Thank you so much for joining the webinar today, between a joint webinar between Edition and bizval. Really excited to again share further insights from my co-host here, Graham Stephen, who's going to be talking about the $1 million mistake from dream deal to due diligence disaster. And obviously a very dramatic title, but we wanted to share some interesting stories about, real life stories about founders and the things that they go through, to hopefully help you guys avoid making the same mistakes during your exit process or whatever, or raise process, whatever it is that you're going through right now or will do in the future. So we're just going to go through a quick intro, then we're going to get straight into the case study content. And then at the end, I imagine that will take us about half an hour in total. And then at the end, that leaves us with 15 minutes for any Q&A for any attendees that have any questions. So just a quick bit about me. I'm the founder of Edition Finance, and we're a high growth business, as many of you are joining. I've been involved in lots of M&A type activity, I suppose, in my career in finance. So lots of sort of sales, acquisitions, fundraising projects, that sort of stuff. So gone through a lot of these things and been involved in a lot of due diligence processes. So I'm happy to share my insights there. And yeah, as I said, founder of Edition. Now, my co-host here, Graham Stephen. Graham, why don't you give us a bit of an intro to you?
Great, thanks, Graham. And yeah, such a pleasure to be here as usual. As Graham said, I'm Graham Stephen. These G's get confusing all the time, but
Too many Grahams here.
maybe we need to do something with that, Graham. Come up with some sort of catchy title for G and G or whatever. But I'm the founder or co-founder of bizval. We've been around for about 2 years, and essentially we are on a mission to empower and educate business owners around understanding the value of their business, unlocking that business value. Obviously, we provide business valuation and exit readiness assessments for businesses, but we're on a mission to do that globally and to reach 10,000 entrepreneurs. We're entrepreneurs ourselves, and we want to help other entrepreneurs along that journey. So, we're really happy to be here today. We love telling stories. We love taking real life examples, not textbook case studies, of actual deals, actual businesses we worked on, and sharing those so that you don't have to make the same mistakes. We operate, I'm based in Cape Town, as you can hear by the accent, but we operate in the UK, in the US, and in South Africa. So the nice thing is we're able to bring, maybe sometimes different dynamics across geographies, commonalities, and also differences. So, Graham, thanks for having me here today.
Thanks so much for joining, Graham. Really delighted to have you. Some of you might have joined one we did just a few weeks ago, actually. This is actually part 2 of a little series we're doing around valuation and exit. And the first one was really great. It was a bit more technical on how to value a business. But we had lots of interest on that one, which was great to see. There's another one as well, I think next Thursday as well, which we'll share with all the attendees here. But this is part 2, and it's about really a real case study about a business that unfortunately lost out on an exit because of reasons we're going to get into right now. So yeah, thanks so much for joining, Graham. Really delighted to have you again. So I'm going to quickly talk us through the agenda as to what we're going to cover today. So we're going to have an overview of the case study. We're going to talk about the valuation and exit readiness assessment. So, how do you get yourselves ready for valuation and exit? The listing process, offer and deal structure, an in-depth process, notes around the process of that as well, which I think is really, really great to get your experience on that, Graham, because I know you've been involved in lots of these processes too. The due diligence process and what went wrong specifically, what lessons we can learn from that process. And then, as I said, at the end, Q&A for you all to get involved with. So with no further ado then, Graham, I'm going to hand back over to you.
Fantastic. Thanks, Graham. And I think, as I said earlier, we like to share real life stories This is not about sitting and listening to a lecture on 100 points around what can go wrong in the due diligence. So, at face value, a lot of what we're going to share might seem quite straightforward. But as one of my mentors once said to me, when you're presenting on a topic, think about that you're presenting to a group of grade, or presenting to a board even. Think about you presenting to a room of grade 6 students. And pitch it at a level that they understand, but also open up the door so that you can ask questions. So as we're going along, if you've got any particular questions, please put it in the chat. I'm sure Graham is controlling and looking at that on LinkedIn, so we can come back to that when we need to. But the case study today, just a brief overview, and we'll go into a bit more detail around that. It was a business that operated in the high-end, or operates in the high-end residential kitchen installation business. Okay. The important thing about them is they had a premium product, and they'd actually captured a significant niche in the market. Just a high-level overview of some of the key metrics in this business. Most of the businesses we work with tend to be in the sort of 2 to 20 million pound revenue range, but this business had about 2 million pounds, getting my countries mixed up here, in annual revenue. They had decent gross profit margins, so 50% GP margin. Their normalized profit before tax, and these are cash profits before tax, after we made the right adjustments, and that were around £600 a year, £600,000 a year. And the thing about them, and they had been growing at 25% a year for the past 5 years, and that growth was expected to continue. They had solid plans in place, and part of this spanned the sort of COVID period. So, post-COVID, there was a lot of focus on people being at home and improvements and all of that sort of stuff. So it also fueled some of that growth. They had 2 owners, both, the one was in his late 50s. He was kind of the operator. He was 58 years old, thinking about slowing down. And the other one was in his mid-60s. The guy in his 60s was more the sales guy. And he genuinely was tired. He wanted out of the business. And, the 2 of them came together and said, look, let's start thinking about how we navigate this exit. So the timing was good. The market was, doing well. And they approached us. In essence, and we'll go through the detail just now, they ended up receiving an offer, a firm offer of £2.5 million for their business. And it was from a commercial installer who was looking to expand their range. So the acquirer was in a similar vertical to them. It wasn't necessarily purely a strategic buyer, but they wanted to kind of diversify and move more into the residential space. And they had put an offer on the table. They had agreed the terms on the deal. So it was a fairly balanced offer, 60% cash upfront. So they would have received, circa £1.5 million cash upfront. And the balance would have been paid out over 2 years on an earn-out period. The idea was that the operator owner would stay in the business for 2 years. And there was a nice ratchet structure where if they hit the agreed targets, he would, be able to increase, the 40%. And on the downside, if they didn't hit their targets, it was a pure linear relationship. So it was a really nice deal for them. And essentially what happened is they were 90% complete. They'd gone through the whole process, and some inconsistencies were picked up in the financial due diligence process. So this was when the investors were kind of looking under the hood, and they picked up some stuff. And the reality is, as we'll cover just now, there was nothing huge in the DD, but there were some important things which caused the deal to fall over. The offer was ultimately amended and withdrawn, and 2 guys who were thinking about, going into a fairly comfortable retirement, now had to walk away from the deal and basically start from scratch. So that, in essence, is the case study we're going to be talking through today. Graham, I don't know if you want to jump in with any comments at this point, but I think, the next step is we'll go into kind of a little bit about the valuation process, how they engaged with us, the exit readiness process, and then we'll go into a little bit about how, what caused the deal to fall over.
Yeah, I think just re-emphasize it, as you said, Graham, really is the the importance of the financial due diligence process. Really, I think about the reason why anybody really buys a company is because they see it as an investment and they want to get a return on that investment. And so understanding the full financial picture of the company, the target company they're looking to acquire, is obviously, really important and paramount to the whole deal process, really. So definitely something which shouldn't be ignored, and really is the foundation of the whole thing, to be honest.
100%. So what this situation is, what's quite unusual about this is often deals can collapse when the business is not ready for sale. Okay, the owners are maybe perhaps a little bit naive and they don't know what they don't know. But what makes the situation quite interesting, and you can move to the next slide, Graham, is that the owners were actually quite proactive here. So as I mentioned, it was shortly after the COVID lockdowns. Their business was in a good place. They'd had 5 years of good growth in the business, and the owners actually proactively started an exit planning process. They actually approached us first, about 18 months prior to the business actually being put onto the market. We conducted a valuation for them, and we did an exit readiness assessment of the business. Now, an exit readiness assessment is effectively taking a step back and saying, well, what would a buyer be looking at when they acquire your business? So, the way we think about it is to say, let's do sort of almost a simplified due diligence process to highlight any red flags in the business that may impede a sale down the line. The valuation was sensible. So the range that they were presented with was 2.3 to 2.7 million pounds. And the exit readiness assessment at that point didn't highlight any massive red flags. But there were a few things that sort of came to light and had to be addressed. So the first one, as I mentioned, the business had gone through some massive growth in the 2 to 3 years prior. But the one thing, as I said, they had 25% growth for the last 3-4 years, but it had been skewed in the last couple of years, and the systems hadn't necessarily been ready for the growth at that time. So their CRM systems, their invoicing systems, they had managed to keep up. They had managed to keep things barely by the skin of their teeth. And then they had to retrofit some of those things as that growth was continuing. So that was the first thing that was identified in the exit readiness assessment, is whilst they had a CRM in place and whilst they had some tools in place, there was a period when that growth exploded that they weren't quite ready for it. The second thing that came up, and this is common with a lot of S&B businesses, is there weren't any audited financial accounts. So they had prepared annual financial statements, but management, it was a salesperson and an operator as the two founders. They'd relied really on reviewing their profit trend. Okay, so they had relied a lot on a profit trend review. They hadn't really looked at the balance sheet per se. And they had filed the annual financial statements for tax purposes and compliance and that, but they never really had those audited and interrogated. Management also felt that the expense of an annual audit wasn't justified. Okay, it can be a costly expense, so they relied on the external accountants and they relied on a sensibility review on those accounting statements. The other thing that had happened is their previous bookkeeper came out, had been fired 3 years previously due to poor performance. Okay, so about 3 years prior to this, they had brought on a new accountant. They had moved from an old, let's call it, I probably shouldn't mention brand names, but I will. They had moved from a previous batch accounting system, offline batch system, to an online system, Xero. And I think I mentioned the names there, but the reality is that migration had taken place about 2 years prior. But prior to that, they didn't have all the source documents and the tracking of that. So there was an opening balance take on 2 years back. Everything looked sensible, but the previous accountant had been fired and a lot of the source documentation had disappeared with him. Okay. And then the last thing that came out in the exit readiness was sort of lack of documentation of processes. So a lot of the processes were fit for purpose. They were great, but they sat in the owner's head. It was instituted as a way of working, but there was nothing written down. So when we engaged with them, we said, look, you need to get ready for sale. The sellers were highly motivated to sell, but by their own admission, as I said, they weren't finance guys. So they relied very heavily on previously the outsourced accountants' expertise, and then, the internal accountant who had come on board a couple of years ago. So that's really the process they went through, and they prepared for this as much as they could. They still didn't go through the audit process. They still felt that that was not justified, and they said they were comfortable with their numbers, but that they would, in need be, if a deal came on the table, that they would have an audit done at that point in time. So a couple of red flags, but they weren't completely unprepared, and that was the process they went through. So I think, Graham, maybe, if you want to just kind of add a few reflections or comments, and then we can move on to the actual listing process, the offer, the deal structure before why the deal actually fell over.
Yeah, I think the final point that you made, which was in this case the company was kind of said themselves as not being finance guys, which I think is fine. I'm not saying all company directors need to be finance guys, but I do think it's really important that if you're going to be a director of a company, you understand, a balance sheet and you understand financial statements at least in a basic form and the purpose of them, because it is so critical to everything you're going to do as a director of a company. And so I think that's something I always recommend directors to sort of upskill on, is in a basic way, just make sure you understand what financial statements are and what they're meaning, and don't rely on an external advisor. Because although they might have your best interests at heart, they're not your company, they're not your shareholders, they're not your directors, and so it's really important that you take responsibility for that. And I think in this case, they probably didn't really take responsibility for that, Graham, which was their ultimate downfall.
Absolutely, and I think, as you'll see just now, a lot of the devil was in the details. So I think let's move on to the sort of listing process. So again, these guys were prepared, and as prepared as they could be. And, for a £2.5 million business, I think they did a lot of the things that were absolutely necessary. So, over a 6-month period, they prepared, they had a professional pitch deck prepared, and the advisors had used management provided numbers and forecasts. And as I said, they did ratio reviews and all those sorts of things on the income statement and the current balance sheets and all those good things. A deal data room was prepared in parallel, so they had a data room with, all their legal documents. They went back and they created processes that they put into the data room. So that stuff was there. Then they approached selected buyers. So there was a targeted list of buyers that they acquired, and they received 4 firm expressions of interests and what we call a non-binding offer. 2 of the offers were lowball offers. They weren't in their price range, and they received 2 in-range offers. Okay. The offer that they accepted was a £2.5 million offer, and as I said earlier, it was a commercial installer looking to expand their range. So it was a good deal. There was a good rapport between, the founders of the new business. In fact, those, well, not the founders, but the owners of the existing business, they had been through a couple of acquisitions previously, so they weren't inexperienced hands. They themselves had been acquired 2 or 3 years before, and bought out the existing owners. So they were familiar with the process. The sellers were happy. It was a good deal. And the funding of the deal, and this is important to talk about, was through a private equity fund. Okay. And this private equity fund was investing on so it was a bunch of other investors, and they required a very comprehensive DD process. And this was obviously one of the condition precedents, so one of the things that had to be in place was audited financial statements. Okay, so at this point, they didn't have them. They weren't overly concerned because they thought their numbers looked okay. And they then moved from the non-binding offer stage into due diligence and finalized offer. Okay, so we can move on to the next slide, Graham. So let's talk about, firstly, what went right and what went well. So DD process, they were into the process 2 weeks in, and a bunch of the boxes were ticked. So there was a good culture fit. The legal due diligence was fine. There was nothing wrong with their brand name. There was no pending lawsuits against them, any of those things. They had good contracts and that in place. The commercial due diligence was fine. They had a way of acquiring customers, their growth plans, and that were all solid. They had good operating margins, nothing funny there. And operationally, they were experts in their field. They had good customer reviews. There were no issues over there. This, I guess, there were a few unexpected surprises that happened around the same time. So in this interim period, in the sort of, 12 months before the deal, is the revenue growth had started to slow. So the post-COVID boom that I spoke about had tapered off somewhat. So they weren't growing at 25, 30% anymore. They were still growing, but that in the last year had slowed down to about sort of 10 to 15%. Okay, so it was a little bit of a canary in the coal mine that growth was starting to slow. The 2023 financial statements were delayed. So as I said, I spoke about the previous accountant having been fired, but the incumbent accountant who was there when this whole deal process had kicked off and provided the decks and everything, he had resigned to take up another opportunity, and he was actually emigrating. So it was nothing untoward about this, but he had resigned while they were busy finalizing the year-end process, and his mind was elsewhere. He was thinking about moving his family and all of those good things. And then during the DD process, this was kind of the main issue. It was discovered that the opening balances from 3 years prior were incorrect. So specifically debtors balances and creditors balances. So whilst the numbers made sense when you did the ratio analysis and all of that, nobody had really questioned these numbers because they looked reasonable. And when the DD happened, they drilled down into some of these and they realized that some things didn't make sense. And what had actually happened is that the previous accountant, so the previous outsourced accountant who was fired, okay, had actually force balanced the books 3 years back. So it didn't actually fundamentally change the net profit position in the current year or even the previous year. It was sort of 2 years back, but it raised a little bit of a red flag. And this came out in the DD. And management then took steps to resolve the historical issue, but the lack of record keeping from before made the process difficult. And as a consequence, there were a few delays that started to creep in. So the people doing the DD couldn't get the information that they needed as quickly as they wanted to. The process was pushed out. There were 2 or 3 missed deadlines that happened in the DD process. And again, as I said, this wasn't a material number in the grander scheme of things. But what then started to happen is what we call deal fatigue started to set in. What was meant to be a 3-week DD process was now going towards 2.5, 3 months. And it started to raise questions together with the slowdown in growth as is there more to this that we're not seeing? And because the owners weren't close to the detail of the accounts, they weren't able to answer those questions. So there was a bit of a trust issue that started to come in. And even that ultimately was resolved, but there was a question mark around that. And essentially what happened is the acquirers looked at this and they said, look, we're still willing to go ahead with the deal, but given all these things that have come up, they drastically revised the terms of the offer. So the £2.5 million exit offer, 60% upfront and 40% earnout, was revised to a £1.5 million offer, okay, and a 30% upfront cash and 70% earnout. And essentially, the deal collapsed because of that, because the 2 founders were no longer in a position where there was sufficient de-risking. They weren't taking enough cash on the table out at the beginning. And this was all due to, a relatively simple error, which came out in the DD process. So Graham, maybe jump in here before we go into kind of some of the lessons learned, which I think are important, because as I said at the beginning, this is not a complicated story, and it's fairly simple things that led to the deal breaking down. But
Exactly.
maybe you want to kind of just jump in with a couple of experiences
Yeah,
that
of
you
course.
might have had on a similar
Yeah.
vein.
I think, I mean, what you've highlighted there really is the whole kind of trust element of a process, whether that's selling your
Mm.
business or raising money from investors, etc. And trust obviously is built in a number of ways, but unfortunately, if a buyer or an investor gets to the point where they just can't trust your numbers, it makes the deal very, very difficult, not impossible. In this
Mm.
case, you can see they were using it as an opportunity to try and get a better deal, which you wouldn't blame them in that case. And I
Mm.
think we see that a lot. We see a lot of companies, founders, companies in general across the board actually that are very fixated on the profit and loss statement. I suppose if you think of
Mm.
your financials as well, there's three statements, isn't there? There's a balance sheet, a profit and loss, and a cash flow. Most people tend to
Yeah.
fixate on a profit and loss, and then sort of a hybrid P&L/cash flow. And most people don't really focus on the balance sheet, which is, to be honest, is frankly I don't want to say the only statement that really matters, but the profit and loss is actually one account on the balance sheet of many accounts. And so I
Yeah.
think we need to get people to switch their focus to really focusing on the balance sheet and making sure you can justify every single balance. Now, for a lot of the juniors that join us here at Edition, it's one of the first things that we teach them really, and really get into them very early on is that the balance sheet reconciliation process is really key to making sure that your numbers are robust and that your profit and loss is actually correct. And if you can't verify your balance sheet, you can't with any confidence whatsoever prove that your profit and loss is correct. And I think that's the message I'd like to get across to lots of people, actually, to all founders and owners, is just really focus on your
Mm.
balance sheet. And I would also recommend, especially a deal of this size, we're talking about a couple of £1 million. It's not massive, but it's a life-changing amount of money for the seller here.
Yeah.
Really invest that extra cash in an audit before you go into this sort of process, so that you're fully prepared, and these numbers have been verified. Now, if they paid whatever it is, let's just say 10, maybe 20K for an audit, perhaps more, depending on the business complexities. They probably would have avoided this and sold the company for the price they wanted. So I think sometimes an audit is a very important and critical element of the process. Even if you don't need one because you're under the threshold. If you're going to go ahead with
Yeah.
a process like this, like selling, definitely go about getting your audited financial statements. But aside from that, just make sure you're working with an accountant who's qualified to do this, and that they can show you a balance sheet reconciliation for a
Yeah.
period, justify every balance on the balance sheet, and really, really, really grill them on that.
Yeah, I think if you move to the next slide, I mean, we can just summarize, the key lessons learned, because I think we've spoken about them, but I think it's useful just to kind of bring them all together. And Graham, as you said, at the end of the day, trust and confidence is the cornerstone of any deal. It's more than the numbers, okay? And in this case, there was some of that, but at the end of the day, there's also, both seller and buyer have to have an adequate level of de-risking. So it wasn't that trust was completely broken. They acknowledged that it wasn't an intentional misstatement, but it was more ignorance more than anything else. Okay. Um, the other second point is a relatively small issue can have knock-on consequences. So in this case, as I said, it wasn't, at the end of the day, it was a 300,000 or 400,000 quid adjustment. It didn't fundamentally change the picture, but it had knock-on consequences around that. So it created this, maybe trust gap is the wrong word, confidence gap, I guess, in terms of the management team. Graham, you've touched on this. I say, the balance sheet where ghosts hide. And that is so apt. I mean, one of the things is, are the reconciliations taking place between the balance sheet and the income statement and the source documentation? Accurate record keeping. goes beyond just having financials that make sense. And I know a lot of us as business owners, we do that. Like we kind of take the big picture view and say, okay, it's moving in the right direction. It makes sense. Even finance professionals often do that. They do a ratio review of the income statement and balance sheet, but that can't happen in isolation. It has to happen with the check of the controls and the recon and the balance sheet checks as well. Source documents, yeah, especially in a digital world, sometimes it's tricky. You keep your source documents on a Outlook folder or your digital world or in a filing cabinet. But especially when doing a system migration, if you're changing accountants or you're doing that, it's important that the source documents from that period get properly stored, kept, copied, duplicated, whatever, so that you've got a record of when that migration happened. We've touched on this already. You need to have competent accountants. That's a no-brainer. But owners also can't just put their hands up and say, well, my accountants have got that in hand. And I think, I know, Graham, the way you work at Addition and that is about educating and empowering the owners with the basics that they need to understand that. They can't just put up their hands and say, okay, well, Addition team's got it. You as owners and owners need to educate themselves on the basics and what those mean for them. And then when it comes to record keeping, directionality is important, but the detail does matter. And you need to have competent people in your corner who pay attention to that detail so it doesn't bite you down the line. So for us, this case study, again, it's not a complicated case study. It's a real life example of a deal that actually fell through a couple of months ago, went through the process, and some really small things that actually resulted in, the deal basically breaking down. So I hope, you can take some lessons out of this if you're listening to the webinar and apply it to your own business and think about if you want to exit one day, what are those little things in your business that you've got a niggling feeling about that need to be dealt with? Graham, I think, if you want to wrap up and then maybe we can take some questions if there are any that's come through and we can take a stab at those.
That's great. Yeah, and I think you're right. As you said, this is obviously a basic topic, I suppose, to some extent. There's nothing overly complicated here at all, but it is really fundamental to a process. I mean, selling a business, raising money, frankly, even just running your business on a monthly basis. This is all really important stuff, and something we take really seriously at Addition. And like you say, we do empower our clients to be able to be responsible for their financials, but also we see it a lot, and I think there's absolutely there's no shame in actually being in a position like this company was in, as long as you realize it and you actually do something about it. And we see it a lot, a lot. And we came across one very recently where a company was raising money from a fund, and all of their accounts were prepared on an Excel spreadsheet, and not surprising to hear that process took probably 4 times longer than it should have, and we ended up they came to us as a new client and ended up unraveling everything and going back and doing it all again, which obviously cost them a lot of money. So I think just realizing it sooner rather than later and doing something about it, whether you're exiting or raising money or not, just really for good practice, really. But really appreciate everyone joining, and I'm just going to pick up a few questions here or comments, Graham, actually, while we've still got some time here. So these first ones was just Dave. Is part 1 available somewhere? Missed it. Yeah, no problem, Dave. We'll get that sorted. We'll send you an email. We did send a mailer last time, but we'll make sure you included this time for part 1. And we'll also remind you about part 3 as well. So we've got a good question here from Jane. I've heard of someone who sold their business. The company then started losing money under management of the new owners, and they came back and sued the exiting entrepreneur for their losses. Is that common? How can you mitigate your risk in a situation like this? Have you got any experience of this sort of situation, Graham?
Jane, that's a fantastic question. And there's a bunch of different ways that I can answer that. But the reality, this talks to the importance of having qualified, independent legal advisors when you're crafting your agreements. So often when an owner's selling their business, it might be something they're doing once or twice in their lives. Okay. Whereas acquirers, particularly people who've acquired multiple businesses, whether it's private equity funds or acquiring businesses, they experience with this. And a lot of the times, the terms and conditions in that, SPA, the share, what's the share purchase agreement, will have certain conditions in those. So, it might say things like the sellers guarantee the profits of the business for the next 3 years. Okay. And if those profits do not materialize, we as the acquirers have the right to sue the owners. Okay. So those kind of clauses can often sneak into shareholder agreements or share purchase agreements. And, I think, again, the first mitigant here is to have an independent qualified advisor in your corner who's done this rodeo a few times before, who knows what things to look out for in those sale agreements, things which are not balanced, things which put you at risk. And that's probably the best piece of advice I could give, because every deal is different. There may well have been a good reason for that. From a buyer point of view, I can understand sometimes why those conditions are in place, because not every seller is necessarily completely above board or ethical. So they could be misrepresenting stuff as well. So sometimes what happens is an acquirer might do a low key or might not do as detailed a due diligence. Okay. So they try to get the deal done quickly. And then they try to protect themselves to say, well, if something goes wrong, we're going to recover it from the owners, or we're going to have a very small upfront payment and we're just going to pay them from future profits. So it's a very tricky one, but having a good legal advisor, tax advisor is another area, and deal advisor in your corner is absolutely critical. Graham, I don't know if you want to add to that. I mean, I think
no, just say I guess that comes down to the contracts, right? The deal documentation, and making sure that is fair, because that does sound like a not very fair deal in that situation, where actually someone's done a deal, and because the business didn't perform after selling it, then they end up getting sued. Seems very harsh, unless there was anything not disclosed. I think importantly, you have to, during a selling process, you have to really disclose anything that you are aware of as the current owner. And I think if those disclosures are not made clear, then that perhaps could leave you open to being sued. So perhaps, Jane, it was about something around some disclosure somewhere, or actually that the acquirer actually did manage to get a contract in place that was in the favor of the buyer. A really good question.
Yeah, I mean, Graham, if I can add a couple of other things to that, and sorry, I mean, these are probably quite important points. If you think about, if you're selling a house, right, it's generally sold as is. But if there's latent defects which have been covered up, there's a crack in the wall, and the seller's intentionally gone and painted over that, for argument's sake, that's on the one hand, so you need to be aware of that. But also, this is an important point that's often not made, is that as a seller, you also need to do your due diligence on the potential buyer. Okay, so I don't know the reasons behind this, but there's a lot of, let's call it, not completely above board buyers. Okay, guys are looking to kind of get businesses on the cheap and all of those sorts of things. Now, as a seller, you need to do your due diligence on those buyers to make sure they are who they purport to be. Go and have a look at past deals that they have done. Go and chat to people that they've acquired businesses from previously and look at what's happened there. So that's another thing that proactively, as a seller, you can do, is who's buying you. Ask the questions. Do they have proof of funds? Have they done deals before? And what has been the outcome of those deals? If in this case, perhaps, you found that they had done 3 deals and they had sued the previous owners 3 times previously, you might not have done the deal in the first place. So, it's a great question. So many different angles that you could tackle it from.
Yeah, thanks so much, Graham. Yeah, one more question, which unfortunately I can't share, but it's about deal structures, Graham. Which is the question is, how often is it that an earn-out is in place versus actually being able to an actual cash offer for the business?
So I'll answer this in sort of 2 parts. The first thing, remember, it's all about risk and reward. So at the end of the day, what the seller wants to get as much cash up front as possible, usually, and the buyer wants to protect their risk. Okay, so usually it's a combination of some cash up front and earnout. Now, often what's tricky with an earnout is if the seller's leaving the business immediately. Okay, so if your business is sale ready, it's got systems, it's got processes, and the day that the deal gets done, the owner can walk out and the business can carry on trading. In those instances, you're more likely to get a full cash upfront offer. Um, but where you're not properly sale ready, there's a bit of owner dependence, and the owner stays on for a period. In those situations, it's more likely to have some kind of earnout. The challenge with the first situation, if you step away from the business and the day the purchase happens, you walk away. If you've got an earnout in that situation, you've no longer got any control over what those future profits and that look like. So there's also, trying to connect what happens to the owner. Are they staying in the business? Are they moving out? So again, this is very, very varied. And it also depends on country to country. So, in some cases, if there is seller finance available and it's a fully funded deal, you're more likely to have a cash upfront offer. But sometimes, I hear them referred to as £1 Charlie. Sometimes you've got people who want to buy your business for nothing and pay you out of future profits. That's the other extreme. So there's no right or wrong answers. Usually, there's a percentage that's paid out up front and then a small portion of an earnout if the person is staying in the business. But I can't pin down a number. I'd love to say 80% of deals are all cash up front and 80% are not.
Every deal is
if
different.
There's an earnout portion, one of the principles we like to say is what can you do as a departing shareholder to influence that? If you've got the ability to influence that and ratchet up your earnings, that's great. What also happens sometimes is that acquirers might not purchase 100% of the shares in one tranche. So what they might say is, hey, we'll purchase 49% or 51% of the shares in the first deal, and you get paid for those. And in 2 years or 3 years' time, we will acquire the balance of the shares. Now, in that situation, you're still a shareholder and you've got an opportunity to influence that future sale. So in a high growth industry, that might be quite attractive. So yeah, it's a long, many permutations to it, but those are some of the factors you need to think about. Size of deal, what ability do you have to stay in the business and influence that? How much risk is associated with the future growth potential of the business or not? All those different things can influence what that structure looks like.
Yeah, thanks, Graham. I think from my side, I'll just add that every deal is different, as you say, but from my experience and what I've seen, especially in this SMB space, is that actually rarely is it ever a full cash offer and you walk away into the sunset, unfortunately. But I know that's what everyone dreams of, being able to sell their company and then tomorrow they don't have to worry about it. They've got lots of cash in the bank, but it rarely happens. Obviously, it's in the interest of the buyer to keep you involved at least for a year or two to make sure that the business continues to trade in the same way that in the same way that you are today, I suppose. So it's a very, very common
100%.
thing. Very common. Perfect. We've got another minute now. If there's any more questions anybody wants to ask, and if not, absolutely fine. What we're going to do anyway is, if you do have any more questions, you can email either of us, either the two Grahams, with any of your questions. We'd love to pick those up with you and have a quick call if need be. Really, in the interest of just helping as many business owners and founders as we can to not make this $1 million mistake or more. I think it's a really easy one that could have been avoided, and I really want to help as many entrepreneurs as possible not make that same mistake. So please do reach out if you need any support at all or have any questions. I'm very happy to support you. And otherwise, we'll be in touch. We'll share this recording with all the attendees anyway and all the registrants. So if you're not here anyway, but if you weren't here, you'll get it. And we will also let you know about the upcoming webinar, which is next week. Remind me again, Graham, the topic of the next webinar.
I think it's a week after that. I think it's the 11th. It's also a Thursday. I think it's 2 weeks from today.
Yes, and that's slightly more positive note, which is about how somebody bought a business and managed to treble it in value over the course of 18 months. So yeah, we'll end the valuation series on a positive note rather than this. Awesome. Thanks so much for your time.
We hook you with fear, and then we leave you with hopes.
Exactly. No, I really appreciate your time and sharing all your insights with the audience here. It's super valuable as always, and looking forward to the next one.
Fantastic. Thanks for having us, Graham, and thanks to everyone who's on the webinar.
Thank you very much, guys. Have a good day.